Welcome to Virtual Wisdom Finance and Accounting Tutorials. My name is Peter and I'll be your host in this particular tutorial. Today, I want us to look at capital investment appraisal under conditions of uncertainty or conditions of risk. But before I introduce that, maybe it's good to mention something. That when you are evaluating projects, we have two conditions of certainty and condition of uncertainty. Certainty means information is available. If, for example, it is a project you're investing in and you know the returns expected from that particular project, maybe in year one you're going to make this amount of money, in year two and all that, the cash inflows are known. That is a condition of certainty. And under condition of certainty, we normally appraise projects using different methods. We have the non-discounted methods, or what we call the traditional methods, which includes the accounting rate of return and the payback period. Then we have the discounted techniques or methods, which we also call the modern techniques, which include the net present value, the internal rate of return, and the profitability index. I'm not going to look at that in this particular tutorial, but in this tutorial, I'm going to specifically focus on the condition of uncertainty or the condition of risk. Now, what do we mean by the condition of uncertainty? Uncertainty is that condition whereby information is not available, or if it is available, we have very minimal information concerning the investments that we are appraising or the investments that we are trying to make decisions on. So due to the unavailability of information, that is what makes us make decisions under the environment of uncertainty. Then the little information that might be there, it helps us assign some probabilities, and these probabilities will enable us to make appraisal decisions on these particular projects. That little information will now help us to make decisions under the environment of risk, because we only have little information. Now, in this particular case, risk and uncertainty is used to mean, or is used to refer to, the dispersion or the difference between the actual outcome and the expected outcome. For example, if you are expecting that you're going to make 100,000 this month, and then you make a different figure from 100,000, that dispersion or that difference between the two is what we are calling the risk. Under this particular tutorial, I'm going to specifically look into investment appraisal of one asset. So if you're making decision of whether to invest in a single asset, what is the criteria that you use if you're making your decisions under the condition of uncertainty, or what we are calling the condition of risk? So in this particular case, we are going to look at two items. There are two criteria that you can use to appraise this particular project. One is using the expected return. Expected return is what you're expecting to gain. What is the gain on this particular asset? Of course, if an asset have a higher expected return, then that asset is more conducive to invest in. But if the expected return is lower than maybe what is set by the management, then it means that that particular asset is not favorable to invest in. Then the other thing that you can use to evaluate this particular asset is the standard deviation. Standard deviation here is used to refer to the risk. What is the risk of investing in this particular asset? So if the risk again is too high, it is not advisable to go for that particular asset. But if the risk is lower, then you can invest in that particular asset. But again, remember, in finance we normally say the higher the return, the higher the risk. And if the return is low, then the risk is also low. So you need also to take into consideration of that particular concept. Like, if I may just take an example here. But before I get to the example, let's check on the formulas. To get the expected return, let's take, for instance, asset A. The expected return of asset A is given by the summation of all i's to 1, or all i's from 1 all the way to n, you take the probability of return, then you multiply that by possible return for each and every state. Then you add all of them together. That is, the expected return of A can also be given by the sum of, sum means the total of PAI multiplied by RAI. And what does this represent? The ERA here represents the expected return of asset A, and that is what we are calculating in this case. Then the PAI here represents the probability of asset A at either state. Remember, we can give the probabilities in different states. Yeah, if for example you have a medium, we have high, we have lower, so those are different states, for example. So you can have a different probability for each and every state, and that is what you're calling the PA, the probability of asset A at a certain state I, which I can be represented by 1, 2, 3, 4 all the way. Then RAI here represents the expected return of asset A at either state. What is the expected return at that particular state? This will come out clearly when we be looking at an illustration. I'll come into that. You can also get the expected return as simple as just you can translate these two, but you are saying it is the sum of. So it's simply the total of P1 R1, P2 R2, Pn Rn all the way. So you find that when you add all these is what you are calling the sum of. So you can also use this as a formula for getting the expected return of a single asset A. Then let's move to standard deviation. How do you get the standard deviation? The standard deviation of asset A, which is normally represented by sigma, that is the standard deviation. Remember the difference between standard deviation and the variance. Variance is sigma squared. So standard deviation of A is normally given by the square root of the sum of all the RAI minus the expected return of A. So this means that you must get the expected return of A first for you to be able to get the what? The standard deviation, because you're going to less every state of RAI, you less the expected return, you square that. This is what you square, the total here. Once you subtract, you square that, and then everything you multiply it by the probability at that state, which we called the probability of AI, or the probability at that particular state. So maybe we are going to see this clearly when we look at an illustration, but basically these are the formulas, or this is what you use to evaluate a single asset in an investment. Let's look at an illustration. Maybe it is going to help us understand better. So the illustration is saying 4 assets have the following distribution of returns. So you are given the probability and you are given the rate of return. So just like we said, you can be given the probability at either state. That is 1, 2, 3, 4, and 5. These are the different states whereby we have the probabilities here. Then these are the assets. You're given asset A, asset B, asset C, asset D. So at the state of point 1, that is the return. At the state of point 2, that is the return. Then at the state of this, that is the return. So you can be able to get at different states. Then the question is saying required compute. Then you are required part A, compute the expected return of each asset. Part B, compute the standard deviation of each asset. So let's look at the solution of this particular question. Let's start with part A. Part A says compute the expected return of each asset. And we said that the expected return of asset A is given by the sum of all the way from I equals to 1 all the way to n of PAI RAI. Now here, what does it represent? The PAI is here, PAI, whereby I can be 1, 2, 3, 4 all the way to 5. Then RAI here represents what? The return at that particular state, which is given in this particular case. Now, let's start with the first item. What is the expected return of asset A? Expected return of asset A. To get the expected return of asset A, we are saying you take all the items, you multiply PAI multiplied by RAI, then you sum them together. That means we take the items. For example, for A, the first state, A is at this particular level, right? Then we have also here. Then we have this one. Then we have like that. And this one here. So at the first state, we have PAI as what? 0.1. RAI as what? 10. Therefore, we multiply 10 by 0.1. See that? Then you add the second state, PAI 0.2. We have it here. Then RAI, which is 10. You have it there. Right? So you multiply that. Then you add. We go to the third state. The third state, the PAI is 0.4. You have it there. Then the RAI is what? Is 10. Then you have it there. You multiply there. You continue like that until you get the last level here. And when you multiply it out, you're going to get 1, the total of here, 10 by 0.1, you get that. Then 10 multiplied by 0.2, you get that. You add that, you get 10%. So the expected return of A will be 10%. Hope you get that. Then let me take another asset, for example. Let me take asset D, expected return of D. This is D. I'll start with stage 1. The pre-AI here is 0.1. So I have it there, 0.1. Then the RAI is what? Is 2. Then I bring it there. I've seen that. Then you go to the other one. The same way, PAI is what? Sorry. The PAI at the second one is 0.2. So I bring it here. Then the RAI again is 6. I bring it down there. I multiply that. So you are multiplying the RAI multiplied by PAI multiplied by RAI. Every state. Like that. If you are to check even the last one, the PAI here is 0.1. It is here. Then I take the RAI of that asset D. Remember, I'm looking at asset D, and these are the items for asset D. So again, I take the 20. Then when you multiply out, 2.2 by 0.1 will give you that. Then say these will give you that. Then these will give you that. When you add all of them together, you get the expected return of D will be 10%. Funny enough, these assets are giving the same expected return, but the best thing is that you have understood how to get the figures. That is what is important. You knowing how to get the expected return of each and every asset. That is what is very key. Part B of the question is asking us to get this, to compute the standard deviation of each asset. And remember, we said that the standard deviation, which is represented by sigma A, is given by the square root of the sum of RAI minus ERA. Everything squared, then you multiply that by PAI. Remember, you look at that. The PAI is outside this particular bracket. Let's see. Let's look at maybe at one let me look at B, because this one, everything here, the expected return equals the rate of return for each and every state for A equals to the expected return of A, and we have already gotten the expected return for A here is 10%, and because it is 10%, and also the returns here are 10%, when you subtract all of them, it will give you 0. So at the end of the day, you're going to have a 0. So let me look at B. So the B, RAI, let me start from here. The RAI for B, the return at ith state is 6, right? Then the expected return of this particular asset B is 10. We had gotten here. The expected return of B is 10%. So I take the 10% here. Then I subtract 6 less 10, then I square that, right? You seen that? So you take 6 less 10, that will give you negative 4. You square that, it will give you minus, it will give you 16, but multiplied by 0.1, it will give you 1.6. Seen that? So what you are squaring is these two. Let me look at the next one. The second state of this asset B, the second state, you have here, remember we are going downwards, right, for asset B. So asset B here, we have 8, right? So I take my 8. I less the expected return, which is 10. Then I square everything. That is 8 less 10 is minus 2. Negative 2 squared will give you 4. I multiply that by 0.2, it will give us 0.8. Seeing that? If I take the last one for asset B, the last one is 14 here, right? RAI is 14. So I take 14, I less the expected return, then I square everything. 14 less 10 is 4, squared is 16, multiplied by 0.1, it will give you 1.6. Then when you add everything here, you get 4.8, you square root that, you get 2.2. So here, the standard deviation for B is 2.2%. And remember what we have said, the standard deviation represents the risk of investing in that particular asset. So the higher the standard deviation, the higher the risk of that particular asset. So if you look at this asset has an expected return of 10%, right? Then when we calculated the risk of investing in this particular asset, the risk is 0. So it means that this asset has no risk in investing in it. But here the risk is 2.2. Let's compare with other assets here. If you look at C, you do the same for C. Again, remember we have said for asset C, look at this. This is the RAI 14. You less the expected return of 10. Remember the expected return for C was 10. You get 4, square that, you get 16, you multiply by that, you get 1.6. You do the same. You get that, it will give you 2.2. When you do for the standard deviation of D, you find that it's coming to 5%. So what does that tell us? It is high risky to invest in asset D than investing in asset what? In all the other assets, because asset D has a risk of 5%, asset C has a risk of 2.2%, then asset A has no risk at all, asset B has 2.2%. Why could that be the case? Look at asset A. The rate of return is the same all through. But if you look at this, the rate of returns are changing, right? And that is why maybe the risk is also increasing with that. So that is it on that particular case. So this was virtual wisdom, finance and accounting tutorials. I hope this information was useful. If it was, kindly make sure you subscribe. Do me a favor by subscribing to this channel. And if you have any question, kindly get me through this contact. I'll give you the feedback you require. Thank you very much for your time and for following this particular tutorial, and thank you for subscribing to this channel.